Don't change that channel, Boston. This is your Retirement Revolution with financial advisor Rob Guy. He is the founder of Tax and Investment Advisors. I'm Spike Spangle. Rob, how you doing today?
I'm doing great, Spike. How are you?
I'm good. Are you ready to tackle today's market volatility? What kind of revolution are we having? We've got, let me see, we got two or three guys, one who kind of looks a little bit like you. They're all in a rocket ship race right now to reach Mars. It seems like our markets are booming. Technology is growing. There's AI tools. But wow. Do we want this kind of market volatility going into our retirement years? Or maybe, if you don't mind, take me through the history lesson. How did we get to here, Rob?
Yeah, no, that's a great question. And one of the things that I've been finding, especially recently, but it happens quite a bit, is people come in and they're like, oh yeah, I'm all set. Investments are all set. Everything's doing good. I'm going to have plenty of money. Retirement is going to be outstanding. And, you know, there were a lot of people who saying that same thing in 1999.
Oh,
right?
Wow.
And right before we had a big market crash. So
the dot-com of 2000.
Yeah, the dot-com of 2000. I'll just give you some rough numbers here. This is not meant to be exact, but just to give you an idea. In January of 1995, the S&P 500 closed at 470.
Okay, I'm writing this one down.
By May of 2000, it was up to 1,400. That was really the big tech boom that we had, right? And QQQ was the NASDAQ 100 ETF that went up like 85% in 1 year. So everybody was jumping into that stuff. Everybody was thinking retirement is going to be great. I'm all set. I have all the money I'm ever going to need. And then what happened was the tech bubble burst, and we had 9/11, and then we went into the 2000, 2001, 2002 correction. By October of 2007, the S&P 500 was at 1,500.
Okay.
So essentially from 2000 to 2007, it hardly moved, right? It went up a lot, down a lot, kind of ended about where it started. Then by February of 2009, so the next big crash we had, okay, people were starting to think, oh, I'm starting to recover from the 2002 debacle, and they made some of their money back, and they think I'm going to be okay. And then what happened? We had the financial crisis, and we had another stock market crash. And the S&P 500 went from, in 2007, 1,500. By the end of 2009, it was at 735.
Cut back in half again.
From May 2000, it was at 1,400. February 2009, it was 735. I don't know how many people worked that into their financial plan back then. Yeah. But, you know, the S&P 500 nearly a decade later was less than it was prior. Now where are we? 6,400 in August of 2025. So we've had a tremendous boom, basically from 700 to 6,400. This is starting to look a lot like the 2000 and 2008 markets to me. And what's so devastating about that is I was in the business back then. I saw the families. I heard the stories of people who thought they were going to be able to retire, who thought they were going to actually have a very comfortable retirement, and they ended up having to go back to work, or their lifestyle was completely changed around. And why? They didn't adjust their portfolio for the time they were in their life. The biggest risk people face with their investments is something called sequence of return risk. Sequence of return risk really just means, are you going to be lucky or are you going to be unlucky when you retire? People who retired, let's say 10 or 15 years ago, where the market went from 700 to 6,000, they're doing great. But if you were to retire right now and the market were to crash, that might change your outlook. And so sequence of return risk is you can't control when that's going to happen. You have different decades of investing in your life. In your 20s, you can make almost any mistake you want. You have all the time in the world to recover. 30s is the same, 40s is the same, even to some degree in your 50s. You're dollar cost averaging. If the market goes down, you're adding to your 401k, you're actually buying shares on sale. That's going to work out just fine for you. And you have time to recover. But what happens is that window, we call it the retirement red zone, say 5 years prior to retirement and 5 years after retirement. That's the most dangerous time in your investing life. And if you actually get unlucky at that point, it could make your retirement a lot different than you think it was going to be. So since you can't time the market, you just have to be prepared in advance for the chance that that might happen. So sequence of return risk is really something that you have to plan for. You have to make adjustments when you're getting into that preservation and distribution part of your retirement. We're all used to the accumulation phase. One of the things that really bothers me is I see people's financial plans and their investment portfolios every day, and everybody still has their pedal to the metal. And pretty much if they're working with most advisors out there, they're still in the accumulation phase, accumulation. Well, that's all well and good as long as things keep working out. But with the markets being as frothy as they are right now, with the demographic and economic and geopolitical things that are happening all over the world, it's a landmine out there, you know. So
and rather than just getting totally surprised by that, because I think you and I are both similar in that I'm positive about the markets. I believe in long periods of time, companies are building things to grow, and their valuations will continue to grow, and there's going to be new innovations and new products and new customers, and people are going to be buying and purchasing. But what we don't know is when those swings are going to happen. Right. So rather than being surprised, you have another free tool from all of the different programs. I really appreciate that. We've got a Boston Risk Quiz. Now, the Boston Risk Quiz isn't about how much risk is there living in Boston. It's about how much risk are you experiencing or are you exposed to in your portfolios. It's going to ask you a few lifestyle questions as well, and it's going to give you a report for yourself to kind of give you an idea of how you feel about risk and how much your portfolio may or may not go down, depending on if there's a market. I mean, we can call it anomaly, correction. Those are some of the safer words. How about a drop? How about like when the elevator drops?
Right.
So, because there was a phrase back from 2009, I wasn't a big fan of it, but some people said, oh yeah, my 401k became a 201k.
Right.
How do you control or protect those big savings accounts that you've got, those big investment accounts, right before your retirement years?
Right.
I mean, you don't stop putting money into them. Can you protect them in some way before you get right to your retirement?
You can, and it's critically important that you do. One of the ways that there's several different approaches one could take. One of the ones that I really like is utilizing something called the bucket strategy. The bucket strategy is more of an income strategy, but it also pertains to your investments. What do I mean by the bucket strategy? Well, for many, many years, we used to plan for retirement by saying you can take about 4% of the value of your account each year as income and raise that with inflation to help meet your expenses. So if you had $1 million portfolio, you could generate roughly $40,000 a year from that. And people would have their 60-40 portfolio, whatever it might be, if people are familiar with that. And you'd just start pulling your 4% a year off, and you'd watch your portfolio go up and down. And it seemed like that was going to be okay from all the analysis they had done up until 2000 and 2008. Okay, the lost decade, they call that, where you had no return on your investment. So here's what you do. Instead of having one big pot of money that you're pulling 4 or 5% a year from, we segment your needs into different buckets. And so the first 5 years or so of income that you're going to need, you don't want to have that in the stock market. You don't want to have to be selling things when they go down, when they're down. And that's why it's important to do your income plan. You want to look at your Social Security, pension, dividend, other income sources, real estate income if you have it, and then figure out what is your retirement income gap. How much money are you going to actually need over and above Social Security, pension, and other sources of income? And then let's say you need $50,000 a year on top of what that's going to bring in. Well, that's $250,000. Well, bucket one has $250,000 in it. That means that's going to be in safe things, high yield money markets, CDs, bonds, different things that aren't going to go down as much. Now, when I say bonds, I don't mean bond mutual funds. I mean fixed bonds where you're buying the actual individual bond and laddering them out. Why is that so important? because bond values and interest rates have an inverse relationship. And we're at a period of time where interest rates went from 18% in the 80s down to 3 or 4% now. Well, that was a 40-year bull market in bonds, because as interest rates came down, bond values went up. What's happening now, though, is interest rates, how much lower can they possibly go? Maybe a little, but they're not going to come down from 18%. So bond funds, and so if you have all your money in a 401k and a bond fund is your only option for safe money, you might want to think about moving that to some place where you could actually buy individual CDs, individual treasuries, individual bonds, all that have a maturity that you can count on. And you know how much money you're going to need each year for the next 5 years. That's not in the market. Why is that important? Because if the market goes down, it might take 5 years or 7 years to recover. So you don't want to be dipping into your stocks when they're down. Does that mean you don't have any stocks? Of course not. We need stocks because we might live till 95 or more. And that's our inflation hedge, right? But we don't want to have at least the first 5 years worth of income subject to market risk. That's one way to do it. Bucket 2 really has, intermediate term risk. That's money you're going to need in years 6 through 10. Money you're not going to need for 10 years plus, let it ride. Okay, that's great. That's how you're going to build your legacy. Yeah. That's going to be your inflation hedge. That might help you pay for long-term care someday. But you don't want a big market crash to affect your ability to generate income. And not only that, it's also just peace of mind. How are you going to feel? If you know you have at least 5 years worth of ready cash available, and then even 10 years in things that's not super risky, well, when the market crashes, you know what you're not going to do? You're not going to panic. You're not going to sell, because the worst thing you can do is sell your stocks when they're down. Everybody knows that. How do you get around that? Well, just emotionally and financially, it makes a lot of sense to have a certain amount of your money out of harm's way, and then a certain amount of your money that's for your intermediate term, and then the rest for your long term. Those Roth IRAs we were talking about earlier, that's great for your stocks, right? Because that's your long-term money. The longer you can leave the money in the stock market, right? It's not timing the market, it's time in the market that's generally going to work out. Well, a Roth IRA is probably the last money you're going to touch, because you want all that tax-free compounding for as long as you can possibly get it. So one of the things that we do is we do an income plan, we figure out what your income gap is, we realize how much money we're going to need the next 5 years, the following 5 years, and so forth, and then we design a strategy to deal with that. So that's part of it. Yeah.
I want to take a quick break, only because I want to make sure our viewers are understanding this. I need some time to decompress it as well. We also want to let you know that we can do a risk review for you. How close are you to retirement? Are you in that retirement red zone, a few years away from it? Are you in your first year or 2 or maybe even 3 of retirement, and you're starting to draw down from those retirement accounts? Yeah, we've seen a lot of growth in our markets recently. But could that music stop? You never know, but you don't want to be caught when that music does end. Let's do your risk review and get you started actually on your entire retirement freedom roadmap. Call the phone number right now, 855-255-1128. More about risk in retirement with Rob Guy right after this.
What my firm is actually known for is removing the financial knot from your stomach. So people say, what do you do? I say, I remove the financial knot from your stomach. And the way we do that is we take a comprehensive look at everything you're trying to accomplish, beginning with the end in mind, and then we put together a very specific income strategy, investment strategy, tax strategy, healthcare strategy, and estate and legacy plan designed uniquely for you. Think of it like this. If you were, say, riding your bike and you fell off your bike and you broke your hip, you wouldn't go to your generalist for that, right? You wouldn't go to your primary care physician. You'd get a specialist to do that. Okay, there's a lot of generalists in my town, but I'm a specialist. So my dad was in the business. I also have a brother in the business. I'm in the business, and now I've brought my 2 sons into the business. So some people are familiar. Everyone in their family is a cop or a firefighter. Everyone in my family is a financial advisor. So we live it, eat it, breathe it every day, and we offer unique, customized solutions in a boutique situation to a limited number of high net worth people who are really looking to minimize taxes and get the most out of life from their money.
Welcome Welcome back to the Retirement Revolution with financial advisor Rob Guy. He's right here in Boston. I'm excited myself because you're kind of helping me figure out this market volatility. Now, I might, in my opinion, have a little while longer to go so I can take these ups and downs of the market.
Yeah.
But you're right. Going through the history of it, we never know when the market's going to go down. You never know how long it's going to last. I'm confident about the markets. I like the growth that we're seeing, but we know that there are market cycles.
Right.
What else can we do that 2 or 3 or 4 or 5 years before retirement to start managing our risk?
Great question. You know, when I was talking about the bucket strategy earlier, people say, I heard what you said about the bucket one, that it should all be in safe stuff, but not necessarily bond funds. But I'm in a 401k. I don't have any options. That's all they give me is the menu of mutual funds that I have to choose from. Well, you might not be aware of this, but there's something called an in-service distribution, which means as long as you're 59 and a half or older, even if you're still working, even if you're still adding to your 401k, you can take that money and roll it over to an IRA. Now, you need to do a lot of analysis to make sure that's the right thing, and I'm not recommending on the show
for everybody in the Boston area, but
I'm just saying it's an option to look at so that if you take that in-service distribution, you can still keep adding to your 401k. There's no problem doing that. You're not stopping your 401k, but it allows you to take a big lump sum of your money and roll it into an IRA. Why is that important? Because in an IRA, you're not limited to the menu of investments that you have in your 401k. It opens up the entire universe of investments to you, where you could buy CDs from banks all over the country. You can buy treasuries, you can buy governments, you can buy corporate bonds, all sorts of different options. And these things have a maturity date where you know you're going to get your money back. The problem with a bond mutual fund is you may or may not ever get your money back because there is no maturity date. So if interest rates keep climbing up over time, well, your bond prices are going to keep going down from 10 to 950 to 920 to 9. And will it ever come back in time for you to enjoy the fruits? Maybe, maybe not. That's a very risky place to be. So if you're in that retirement red zone and you're sitting in a 401k, you may want to consider an in-service rollover, no taxes to be paid on that. It goes tax-free from the 401k to your IRA. Now you open up the entire universe of investments. Now we can do some real strategic planning.
And I like what you said, that you're not stopping the contributions while you're working. It's not changing what you're doing in the workplace. You're going to keep putting the same amount in.
Sure.
You're just now taking a portion of this off the table. If you want to know how do you avoid a drop of 2008, 2009 and not have your 401k cut in half, it's taking control of your investments.
Right.
But then it's, what do you do with that?
Right.
Because you're saying the whole universe. I like that you were talking about those individual bonds. Maybe we will start setting up some income.
Yep.
I'll throw an absolute curveball at you, Rob. I knew you weren't going to. What about maybe even starting something like an annuity and maybe possibly creating your own pension-like plan? Do you use a tool like that as a possibility?
It's a possibility. So they're not appropriate for everybody, and there's good ones and there's bad ones. But there are certain guarantees that you can get with them that you can't get anywhere else. And one of the ways that people will use it is they will set up a lifetime income stream with a portion of their 401k. If you think about it, the 401k was never actually designed to replace your retirement. It is actually, when they were originally put in place, designed to be an extra savings vehicle for highly compensated executives. But what happened was Ford and all these other companies realized they were paying out more in pension benefits to people who don't work for the company anymore than they were paying for people who are literally still working. And so everybody got rid of pension plans. And whenever I run into somebody and I say, do you like a pension? They say, oh man, if they have it, they think it's the best thing in the world. If they don't have it, they really wish they had it. And I say, do you like Social Security? They say, oh yeah, I love it. What do you love about a pension? What do you love about Social Security? Well, it's that guaranteed income I know I can never outlive. It gives me security. Well, there's an income strategy called the flooring strategy, which basically says, I know I'm going to get a certain amount from Social Security. I may or may not have a pension. I probably don't have a pension. I'm not comfortable with that $30,000 or $40,000 a year as my only guaranteed income. So I want to set a floor on how much income I know I can get no matter how long I live. And you can do that by using a portion of your 401k to purchase a lifetime income through an annuity. Now, there are some that are loaded with fees that you don't want to have anything to do with, and like everything else, there's good and there's bad. It's never black and white. It's never all right or wrong. You just have to analyze your situation, find the right vehicle that might be good for you, but if you'd rather have 60 or 70,000 a year guaranteed for the rest of your life instead of just 30 or 40, that might be something you might want to consider.
Thank you so much for that. We're going to take a very, very short break here, but through that, when you say it could be a good tool, from what I understand from you as a wealth advisor, generally speaking, there isn't one tool that is the total solution for all of your income needs. So just talking about an annuity or an individual bond in itself, or even the wealth platform, there's many different tools that you use. So I'd like to talk about some of those 5 steps of how you retire free, if you don't mind, when we get back. Sound good?
Sounds good.
You, right now, can call the phone number. Let's get you started on your own retirement freedom roadmap. 5 steps, complete process for you being and staying retired that includes income, taxes, how much risk are you taking, what are you paying in fees, estate planning conversation, healthcare conversations, timing of Social Security, efficiency of Social Security, all that, and then your own private questions about retirement. Call 855-255-1128 right now. We'll get you started on your own retirement freedom roadmap. No cost to you. We'll be right back.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
As we just said on the commercial there, you can call and get your own no-cost second opinion review. Are you already in retirement? You hear this phrase a lot as well. I have a guy, or I've got a person, I got somebody who helps me with that. And it might be the default contact from one of your big box firms where your 401k was, but you actually have a 5-step process to what you do. You've written the book on it, Retire Free. This book takes you through it, and I can actually get a complimentary copy to you, the viewer, when you call the phone number. I'll explain that more, but what exactly is the 5-step process when it comes to market risk? How does it help with us?
Well, when I run into people and they tell me they have a financial plan or they have a financial planner, oftentimes what I find what they really have is just a portfolio. Nobody is looking at the income strategy. Nobody is looking at the tax strategy. Nobody's talking about healthcare or estate planning. And if they are, it's just lip service. They're really not doing much. And if you're with one of the big box firms, you're just one of thousands of people who has the same cookie cutter portfolio that everybody else has. And 9 out of 10 times, it's based on growth. And it's putting you in tremendous risk, potentially, if you are in that retirement red zone. So instead of just relying on, the person that got you here, the person who got you to retirement, let's face it, that actually wasn't that difficult. All you really needed to do was spread your money out in a few funds, have the discipline to put the money aside, and accumulate money for retirement. And yeah, that is not easy, but it's not that difficult either, especially when the stock market goes from 500 to 6,000, right? Everybody is a hero. But what we want to do is we want to take a much more comprehensive look at the 5 areas of your financial plan that are the most important. And we want to give you customized, individualized service, information, and portfolios, really a high level of service to a limited number of people, as opposed to a limited number of service, level of service to a large number of people. We start with the income plan. We want to make sure you're never going to run out of money. What is people's number one fear? Running out of money. Well, a lot of times people say, oh, I'm pretty good. I think I have enough money to live on. But my portfolio is the same portfolio I've had for years. Am I taking too much risk with my portfolio? Let's analyze your portfolio. Let's say if we had another 2008, 2009, how much would your portfolio go down? Would it go down 10%, 30%, 40%? I run these analyses for people every day, and I say, do you consider yourself a high-risk person? They say, no, I'm really pretty conservative. And then I run their portfolio, and they'd lose 50% of their money if we had another market correction. So we want to take a look at how much risk you're taking. Is that appropriate? How would it affect your portfolio if things were to go down? Then we want to take a look at your tax strategy. So I'm not talking about what your accountant does. I'm not a tax preparer. We have CPAs that we use to help prepare the taxes for our clients. But we're talking about tax planning. What is your lifetime tax bill going to be if you go with the government plan? You know, if you get that statement from Fidelity, it says you have $1 million in your IRA. It doesn't actually say, but you owe $400,000 of that to the IRS. You actually only have $600,000 of purchasing power. You think you have $1 million, but you don't. You have a massive IOU to the IRS. Let's figure out what that bill is for you and how can we minimize that risk utilizing Roth conversions and several other advanced techniques that we have in place. Then people say, well, I don't really need any type of long-term care planning, and they point to their wife and they say, there's my long-term care plan. I say, wonderful. When you go home, lie on the bathroom floor, have her pick you up, carry you over the bed, take care of you, put you on the toilet, feed you everything. If she can do all that, great, you have a long-term care plan. If you don't, you might need another strategy. And then estate planning. Are you going to pay too many taxes or have money go to the wrong people or have a lot of confusion and fighting with your family because you didn't make your intentions clear? So let's make sure everybody knows.
Clear and written down.
Clear and written down.
Yeah. Those are some of the 5 steps that you go through in your process. For our viewers, you can actually go through that process at no cost to you. You can get started by calling the phone number right now down on the bottom of the screen, the 855-255-1128. It'll be a first meeting of going through all of these conversations that Rob was just talking about. Then we'll probably send you home, bring you back for another meeting, and then he's going to lay out the plan for you, your retirement freedom roadmap at no cost to you. And just for getting started on that phone call coming in, we'll send you a complimentary copy of the book. Thank you so much for watching. We'll be back with the Retirement Revolution once again next week.